On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Let's talk about the week that was, then let's turn our attention to what's coming up in the week ahead. The US share market had another good week. The S&P 500 index rose another 1.2%, hit new highs. It was buoyed by solid economic indicators and a rate cut from the Federal Reserve. The Russell 2000, which is a US small cap index, was up for a 7th straight week, while credit spreads tightened to levels not seen since 1998. So good news for risk assets all round. European shares were 0.4% higher, while emerging market equities posted a gain of about 1.2%. In contrast, the Australian ASX 200 fell about 1%, and the FTSE 100 in the UK was also down. It was about 0.7% lower. The local NZX 50 limped its way to a marginal gain. That came on the back of a much weaker than expected GDP report for the June 2025 quarter. However, the index is still up a very healthy 2.3% for September, and it's on track for its best monthly gain since May. Local interest rates slumped. The 5-year swap rate was down 15 basis points to 3.14%. That is the lowest that we've seen since March 2022, and that came on the back of that GDP report as well. The NZX Corporate Bond Index has delivered a very healthy 5.1% return so far in 2025, so that's outpaced global bonds, which have done about 4% so far this year, and the local share market, which is up just shy of 1% this year. Looking back at some of the key releases and developments, and geez, it was a busy week. We'll start with central banks, and the Federal Reserve was the main event. It cut rates for the first time since last year. It was a 25 basis point cut. That was what markets were expecting, the first change since December 2024. And that sees the upper bound of the Fed funds rate fall to 4.25%. Remember, it peaked to 5.5% through 2023 and through the first half of last year. That was actually the highest we'd seen since 2001. So it was an 11-1 vote, and there was less dissent than many had expected, especially after that July meeting where we saw 2 voters disagree with the consensus, and that was something we hadn't seen at the Federal Reserve since 1993. This time only 1 dissenter, so a little bit more consistency amongst the voting members on that Fed committee. The updated SEP summary of economic projections and the closely watched dot plot of individual expectations, that's anonymous, they suggested a wider disparity in views though. So the median participant expects 2 further 0.25% cuts this year, but half of the committee expects just 1 cut or no cuts in 2025 from here. There was also 1 dot which pointed to a total of 125 basis points of additional reductions this year. So that one was really out there. So I think what that tells us is that beneath the surface there are very differing views amongst the voters on the Fed about what should happen from here. More cuts, less cuts, a faster path of easing, a slower path of easing, a lot of uncertainty. What about the SEP forecasts and market expectations? Well, there were a few contradictions there as well. We saw increasing discussion about downside risks to the labour market, and there was an acknowledgement that inflation pressures have grown in some categories. But when you look at the SEP, it reflected an increased estimate for economic growth this year, so it got more upbeat, and estimates for the unemployment rate were reduced. over the forecast horizon. So those things don't completely tie up with the commentary that we heard. When we look ahead at market pricing, and this is probably what matters most, markets see a very high chance of 0.25% cuts at the last two meetings of this year. So we've got one in late October, and then we've got one in mid-December. So the Fed now at 4.25%, markets see another cut, then another cut, and that would see the Fed funds rate, the upper bound of it at least, finish this year at 3.75%, and then you would get further easing to come in 2026. So that was the Federal Reserve, that was the big one. There were two other central bank meetings, one in the UK. The Bank of England didn't do anything, left rates unchanged. Their policy rate is at 4%. Inflation has been creeping higher in the UK. The headline inflation rate hit an 18-month high of 3.8% in July. And we got the August numbers last week, I think, as well, and they were unchanged, still at 3.8%. So because of that, we won't see another cut in the UK until next year, in all likelihood. Japan was interesting as well. Now, this one came out on Friday afternoon, the Bank of Japan, and it probably was seen as the least exciting one after the Fed, after the Bank of England, but it was actually pretty interesting. The BOJ left interest rates steady at 0.5%, but it did announce that it would start selling some of its holdings of ETFs and real estate investment trusts. So that was interesting. Also, the decision to leave interest rates unchanged, that wasn't unanimous. There was a vote and it was 7-2. So 2 dissented. They said we should raise the short-term interest rate from 0.5% to 0.75%. Remember, the Bank of Japan is in the process of raising interest rates. They're sort of going in the opposite direction to all the other central banks for a few reasons that we don't have time to delve into. But 7-2. So the majority said no change, but 2 of them said we actually should raise it, and that really got the market's attention. Bets for a rate hike before the end of this year increased in the wake of that, and the Japanese yen rallied quite strongly. So markets now see about a 50% chance of a hike at the next meeting in late October, and they see about a 66% likelihood of a hike by the December meeting. And before this meeting, we didn't see any moves until next year sometime from the Bank of Japan, so that was a really interesting one. So that was the trifecta of central banks. Here in New Zealand, the highlight, and it was more of a low light to be honest, was the GDP report for the June quarter. We expected it to be disappointing, but it was much weaker than expected. It was pretty ugly, to be honest. We saw GDP on a quarterly basis fall 0.9%. That's much weaker than the Reserve Bank and financial markets were expecting, which was a 0.3% decline. On a per capita basis, the decline was minus 1.1%, and that's similar to the level of weakness that we saw over the second half of the 2024 calendar year. So this was a bad report, and even though we've seen a rebound since then, some of the more recent data looks much better. Remember, this is old. This is April, May and June. We're now in late September. So even though we have seen an improvement, it does tell us that that trough was much lower than we were expecting, and that there's been more spare capacity in the economy than most people expected, certainly more than the economists and the Reserve Bank expected. So what does that mean for the OCR? It means it's going down further and potentially faster than we thought before. So markets now see a 0.25% cut in October as a certainty. I think it's the 8th of October that the meeting is. And pricing implies about a 30 or 40% chance that we will get a bigger 50 basis point cut next month in October. People now also see the OCR going down to 2.25% rather than 2.5% as previously expected. So we will need to see more stimulus from the Reserve Bank, and that probably means mortgage rates and term deposit rates are going down a little bit further, which I guess when you look out 6 months, 12 months is not a bad thing from the perspective of households and budgets and potentially asset prices for things like the share market, and maybe the housing market will get a little additional boost there if mortgage rates come down a little bit lower from current levels. So that was the GDP report. Not great news, but at least the Reserve Bank does have some firepower up its sleeve that it can deploy pretty swiftly to try and give us that boost that we need. Dairy prices, we got a GDT auction result on Wednesday morning too. The index fell 0.8%. That's its third consecutive decline and its seventh fall out of the last 9 auctions. So the headline index is about 10 or 11% below the level it got to in May, or admittedly that was a 3-year high, but it's only 1.6% lower in 2025. So it hasn't been terrible, and you've seen the currency come off a bit, and it fell again last week against all other major currencies in the wake of that GDP report and in the wake of increased bets for additional OCR cuts. So the currency has helped the farming sector and all exporters for that matter. The housing market, we got a housing market report last week for August, pretty subdued, a bit of a rise in prices, but still quite subdued. Activity did slow. National sales volumes were down about 11% compared to July, a little under 4% lower than the same month a year ago. The days to sell unchanged at 48. Bit of an improvement in prices. The National House Price Index up 0.4%. That's actually the first increase since February, and it snapped a 5-month decline. So not too bad, but we still haven't really seen a whole lot of action across the housing market. Turning to the week ahead, and the global highlight will be flash purchasing managers indices, PMIs, for the month of September. These will cover many of the major regions, and they will be a very timely pulse check on the health of the global economy. So I really like PMIs. I'm always going on about them, and I'm always talking to you lot about them when they're coming up. The reason I like them so much is they're more timely than anything else we see. So that GDP report that we're talking about, that's from 4, 5, 6 months ago, whereas PMIs are real time. They tell you what's happening right now, today. So they're not always perfect, but they're a very good indicator of where things are at. And these will be out on Tuesday. We will get the Australian measure at 11 o'clock New Zealand time, Japan just after lunch, 12:30, then the UK, Europe and the US that evening. Last month's PMIs, August, were strong. All the major regions were above 50, which is the break-even level. The Aussie one particularly strong. That was the highest since April 2022. Japan was up, Europe improved, the UK was strong, the US remained very buoyant. It hit the highest levels we've seen since December last year. So the PMIs have been telling us that the global economy is in good shape, and hopefully that will continue in September. The other key release that we'll be watching internationally is the PCE inflation report for August out of the US. This is important because it's the Federal Reserve's preferred inflation measure. And especially with the Fed having just cut interest rates last week, talking about it as if it's a risk management cut, so they're sort of trying to hedge their bets about what they do next, this inflation report will be important. The headline PCE expected to rise 0.3% for the month. The core expected to rise 0.2% for the month. I know you're more interested in the annual inflation rates, and at an annual level, headline PCE inflation expected to accelerate to a 6-month high of 2.7%. The core PCE expected to remain steady at 2.9%, which is the same as last month, which was the highest since February. So we'll be watching that PCE inflation report, see if we break through that 3% level. Hopefully we don't. It would be good to stay in the 2s. It's a much quieter week here in New Zealand, which will give investors more time to ponder that weaker than expected GDP report and how the Reserve Bank might respond at its October meeting. Many of the economists are now picking a 50 basis point cut in October, then a 25 in November, which would see the OCR finish the year at 2.25%. And that would be as low as it goes, and it would hopefully spur a recovery into 2026, so the Reserve Bank wouldn't have to do any more beyond that. In terms of key releases between now and that October meeting, I think the most important one is the QSBO, the Quarterly Survey of Business Opinion. This is the NZIER survey, and it will come out in the first few days of October. So if this is much stronger than expected, it could dissuade the Reserve Bank from going 50, and they might just do 25, as we all thought before the GDP report. But if the QSBO comes in okay but not particularly good, or if it comes in a little bit lackluster, then 50 is certainly on the table. I think they will be inclined to look for a circuit breaker. At least I would be. I think 50 would actually be a wise move when you face the reality of where our economy seems to be at with this fresh data and information at hand. There will be a few corporate releases to monitor too. We've got earnings reports here in New Zealand from KMD Brands, that's Kathmandu and Fonterra. We've got the Air New Zealand annual meeting, so maybe you'll get a trading update. Further afield, Micron, Accenture and Costco all releasing their latest earnings reports. A bit of housekeeping too. I will be away next weekend, so I won't be producing one of these episodes, or I won't be producing the report that goes with it. One of my kids is playing in a National Rugby League comp in Rotorua. So go the Tauranga Moana Māori under-10s. Hopefully they have a cracking tournament. They've got a sharp little team, but I'll be away with the young fella at that, doing something much more interesting than recording a podcast about economics and markets for you lot. All right, so thanks for tuning in. Thanks for listening. Hopefully that was useful, and we'll talk again soon. See you later.
For more insights, visit craigsip.com.